Part 1. Why investing is the key to long-term wealth. Most people spend their entire life working for money. They trade their time, their energy, their health, all for a paycheck that's already spent before it hits the bank. But here's a secret that the wealthy have always known. Money should work for you, not the other way around. Investing isn't just about getting rich quick, it's about buying your time back. It's about freedom. It's about knowing that even while you sleep, your money is busy working, growing quietly in the background. Let me share a simple story. Imagine two friends, Ali and Usman. Both start working at age 25. Ali decides he'll spend everything he earns: new phone, new clothes, trips, dinners out. Usman, on the other hand, decides to invest just $200 every month in the stock market. Fast forward 30 years. Ali has only memories, but Usman? He now has over $250, 000 plus, just from investing small amounts regularly without lifting a finger. That's the power of compound growth, the eighth wonder of the world. So why is investing in the stock market so powerful? Because unlike a savings account, which barely beats inflation, the stock market has historically given 7%. 10% average annual returns after inflation if you stay in it for the long term. Why should you care? Think about this. Inflation silently eats away at your money every year. If you're not investing, you're actually losing purchasing power. That's why you must learn how to grow your money, not just save it. In this first step, your job is simple. Shift your mindset. Stop thinking you're too poor to invest. Stop waiting to save enough to start. Start believing that you deserve to build wealth, not just work for it. So remember, it doesn't matter where you start, it matters that you start. In the next part, we'll destroy the biggest myths that hold beginners back from investing. Trust me, once you break those mental barriers, the stock market becomes much less scary and way more exciting. Perfect. Let's keep this big, detailed flow going. Here's your part 2 for your long script. Part 2. Common myths about the stock market debunked. Opening hook. You. Okay, so you get it. Investing is the key to long-term wealth. But I know what you might be thinking. Isn't the stock market risky? Isn't it just gambling? Don't you need thousands of dollars to start? These thoughts hold back millions of people, so let's crush these myths right now, one by one. Myth #1: investing is gambling. First, investing is just like gambling. Here's the truth. Gambling is purely chance. The odds are designed for the house to win. Investing, on the other hand, is ownership. When you buy a stock, you own a piece of a real company with real employees, real products, and real profits. Good companies create value over time and you benefit. Unlike gambling, you can manage risk by doing research, diversifying, and staying invested for the long term. Quick visual example. Would you bet all your money on a horse? Probably not. But would you bet on Apple or Google making money in the next 10 years? That's investing, not gambling. Myth #2: you need a lot of money to start. Second, I need to be rich to invest. Absolutely false. The stock market has become more accessible than ever. Today you can start with as little as $5. Fractional shares, zero commission brokers, there's no excuse. The magic is in consistency, not huge sums. $50 every month beats waiting for the perfect time to invest thousands later. Mini story. I know a guy who waited 10 years trying to save up enough to invest. Meanwhile, his friend started with just $25 a month. Who do you think is ahead today? The one who started small but started early. Myth #3: the market is too risky. Third, it's too risky. I might lose everything. Investing does carry risk, but so does doing nothing. Inflation is guaranteed to make your money worth less every year. Keeping cash in a jar loses value. But investing smartly in diversified quality assets historically grows your wealth over time, even through market ups and downs. Example: In 2008, the stock market crashed over 50%. If you panicked and sold, you lost. If you stayed in and kept investing, you'd have doubled or tripled your money in the next decade. Bonus myth. I'm too young, too old. People say, I'm too young, I'll do it later. Or, I'm too old, what's the point? If you're young, you have time on your side. If you're older, you still have compounding power, and investing beats letting money rot in a low-interest account. So if any of these myths have been holding you back, let them go. You don't need to be a genius or rich. You need to start wisely, consistently, and with a long-term mindset. In the next part, I'll show you how to see investing not as a gamble, but as a strategic plan that works in your favor. Final line for this part. Stick with me, we're just getting started. In part 3, we'll break down the difference between investing and gambling, so you know exactly how to protect your money and grow it the smart way. Part 3, the difference between investing and gambling, deep dive. Now let's settle this once and for all. Is the stock market gambling? The short answer, no, not if you understand how to do it properly. But many people still treat it like a casino, and that's when they lose money. The core difference. So what's the difference? Gambling is betting on an outcome you can't control. You play with chance and odds stacked against you. Investing is buying a piece of a business that makes money. You can study that business, understand its products, leadership, industry trends, and you get to own a slice of its future profits. Example, casino versus a company. Imagine this. You go to a casino and put $1,000 on red. The odds are fixed, the house always wins long term. Now imagine you put $1,000 into a solid company like Apple. That money helps the company grow, they build new products, expand, make more sales, and you, the shareholder, get rewarded through share price growth and dividends. One is pure chance, the other is value creation. Why some people lose money? Here's the truth. Many beginners lose money because they treat the market like a lottery ticket. They buy random stocks because of hot tips. They panic sell when prices drop. They gamble instead of invest. How to invest the right way. Key point. Investing the right way means doing your homework, understanding what you're buying, diversifying, never betting everything on one stock, staying invested long-term so compound interest can do its magic. Analogy, think of it like planting seeds. Gambling. You throw seeds in the air and hope one lands on good soil. Investing. You pick the best land, plant carefully, water regularly, and give it time to grow. Same seeds, totally different approach, totally different outcome. So here's your takeaway for part 3. Always ask yourself, am I buying because I understand the business and believe in its future, or am I just hoping to get lucky? If it's the latter, pause and rethink. So stop treating your money like chips at a poker table. Start treating it like seeds you want to grow into a forest. In part 4, we're going to break down how the stock market actually works. No complicated jargon, so you really know what you're doing before you invest a single dollar. Ready to make the stock market work for you, not against you? Let's keep going. Part 4. How the stock market actually works. Simple, clear. So many people feel confused or intimidated by the stock market, but when you break it down, it's really simple. In this part, I'm going to show you exactly what the stock market is, how it works, and what happens when you buy a stock. No confusing jargon, just real talk. What is the stock market? Think of the stock market like a giant supermarket, but instead of groceries, you're shopping for shares of companies. A share is a tiny piece of ownership in a company. When you buy a share, you become a partial owner. If that company grows and makes profit, the value of your share goes up. Why do companies sell shares? Why do companies even want to sell pieces of themselves? Simple, they raise money to grow. Let's say a company wants to build new factories, develop new products, or expand overseas. Instead of taking a loan from a bank, they can go public, meaning they list their shares on the stock exchange, and people like you and me can buy them. Where does the trading happen? All this buying and selling happens on stock exchanges like the New York Stock Exchange, NYSE, or the Nasdaq. Think of these like giant marketplaces where millions of transactions happen daily. How does a stock's price change? Stock prices move up and down based on supply and demand. If more people want to buy than sell, price goes up. If more people want to sell, then buy price goes down. But behind this is investor sentiment, company performance, news, global events. It all affects the demand for that stock. Example, how you profit. So how do you make money? Two main ways. 1. Capital gains. You buy a stock for $50, it goes up to $80, you sell and make a profit. 2. Dividends. Some companies share a portion of their profits with shareholders. You get paid just for holding the stock. Where does the money go when you buy or sell? Here's what confuses people. When you buy a stock, that money doesn't go to the company, except during the initial IPO. It goes to the person selling their shares. You're buying from other investors in the market. Key point, you versus traders. Long-term investors buy solid companies and hold them for years. Traders buy and sell frequently to profit from price swings. Most beginners should focus on investing, not day trading, because timing the market is nearly impossible. Now you understand, the stock market is just an auction, a place where people buy and sell ownership in companies. Your job is to pick great businesses you believe will grow and hold them long enough for your money to multiply. In the next part, we'll talk about a secret that separates successful investors from everyone else, why time in the market beats timing the market. This single idea could save you from losing thousands of dollars and years of regret. Opening hook. You. If you remember only one thing about investing, remember this: time in the market beats timing the market. Most beginners try to buy low, sell high perfectly every time, but trying to predict the best days and avoid the worst days is almost impossible, and it often backfires. The truth about market timing: even professional investors with huge teams, research, and algorithms fail at timing the market consistently. The reality is, missing just a few of the best days can destroy your returns. Powerful example, missing the best days. Let's say you invested $10,000 in the S&P 500 index in the last 20 years. If you stayed invested, you'd have made around $40,000, $50,000. But if you missed just the 10 best days in those 20 years, your returns could drop by half. Why? Because the best days often come right after the worst days when fear is high. Visual roller coaster analogy. Think of the stock market like a roller coaster. There are ups and downs, but if you get off halfway through the ride because you're scared, you lock in your losses. But if you stay on the ride, you finish the journey and enjoy the thrill of going up again. Story: Warren Buffett's wisdom. Warren Buffett, one of the greatest investors ever, says, "Our favorite holding period is forever." He knows the longer you hold good investments, the better chance you have to let compound growth work its magic. Why beginners mess up? Beginners panic when markets drop. They sell low, then they try to buy back when it feels safe, which usually means buying high again. That's the opposite of how wealth is built. How to actually win. Instead of obsessing over timing, focus on time in the market. Pick solid investments. Add money consistently. Stay invested even during dips. History shows the market always recovers. Every crisis has been followed by growth. Action step for part 5. Your takeaway for this part is simple. Be patient. Don't panic when the market dips, see it as a sale. Trust the process. Let your money stay invested so it can grow. Closing for part 5. In the next part, we'll talk about setting clear financial goals, because knowing why you're investing makes it easier to stay calm during the ups and downs. Stick with me, you're building the mindset of a real investor, not a gambler. Let's keep going. You know what separates people who invest successfully from those who panic and quit? It's clear goals. If you don't know why you're investing, you'll get scared during a downturn, or you'll sell too early when you see small profits. So in this part, let's set your financial goals step by step. Why goals matter. Investing without goals is like driving without a destination. You'll run out of gas or get lost. Goals keep you focused, disciplined, and motivated when things get tough. Types of investment goals. Most people have three main types of goals. 1. Short-term goals. 1. 3 years. Emergency fund, vacation, big purchase. 2. Medium-term goals. 3. 7 years. Buying a house, starting a business. 3. Long-term goals. 7+ years. Retirement, kids' education, financial freedom. Realistic example. Let's say you're 25 now and want to retire at 55. That's 30 years of investing. If you invest $300 a month in an index fund with an average return of 8%, you could end up with $450,000 to $500,000 or more. That's the power of knowing your time frame and sticking to your goal. SMART Goals Framework. Your goals should be SMART. Specific, know exactly what you want. I want to retire at 55 with $500K. Measurable. You can track progress. Achievable. Be realistic. Relevant, aligned with your life. Time-bound, set a deadline. How to break goals. Down. Break big goals into smaller steps. Example, I want $100,000 in 10 years. That means about $830/month with an expected average return. Now you know how much to invest every month. Visual, the roadmap analogy. Think of it like a road trip. Your final destination, your big goal, the route, your investment plan, fuel, stops, regular contributions you make. If you know your destination, you won't take random detours. Keep it flexible. Life changes, so your goals might change too. That's fine. Review your goals every year. Adjust your contributions if needed. Just keep moving forward. Action step for part 6. Take a piece of paper, write down. What do you want? When do you want it? How much do you need to invest every month? This clarity will make you a confident investor, not an emotional one. Closing for part 6. Now you have a solid why behind your investing. In the next part, we'll talk about the different types of investments you can choose from: stocks, index funds, ETFs, and more. You're building a strong foundation. Stay with me, and let's level up your knowledge step by step. Part 7. Understanding different types of investments. Okay, you know why you want to invest, and you know how the market works. But what exactly can you invest in? This is where many beginners get overwhelmed, so let's break it down step by step. Stocks, index funds, ETFs, mutual funds, and more. By the end, you'll know exactly which options might be right for you. 1. Individual stocks. When you buy a stock, you own a small piece of a single company, like Apple, Tesla, or Google. Pros. Potential for high returns if the company does well. Cons. Higher risk. If that company struggles, your investment drops too. 2. Index funds. An index fund is a type of investment that tracks a whole market index, like the S&P 500, which includes the 500 biggest companies in the USA. It's like owning a tiny slice of each company in the index. Pros. Diversification, lower fees, less risk than buying single stocks. Cons. You won't beat the market, but you'll match its performance, which is great for most people. 3. ETFs, exchange-traded funds. ETFs are like index funds, but trade like stocks on the exchange. Example: The SPY ETF tracks the S&P 500. You can buy or sell it anytime the market is open. ETFs can track indexes, sectors like tech or healthcare, or even commodities like gold. Pros: flexible, low cost, easy to diversify. Mutual funds. Mutual funds are similar to index funds, a pool of money managed by professionals who pick where to invest it. Some are actively managed, higher fees, and try to beat the market. Some are passively managed, lower fees, and just track an index. Pros: hands-off, good for beginners. Cons: active funds often underperform index funds after fees. 5 bonds. Bonds are loans you give to companies or governments. They pay you interest over time. Less risky than stocks, but lower returns. Good for balancing risk in your portfolio. Real estate investment trusts, REITs. REITs let you invest in real estate like malls, apartments, and office buildings without actually buying property. REITs pay dividends and are traded like stocks. A good way to add real estate exposure to your portfolio. How beginners should choose. If you're just starting, you don't need to pick all these. Many beginners do well with a simple strategy. Focus on broad index funds or ETFs. Add individual stocks later once you're confident. Use bonds and REITs to balance risk as your portfolio grows. Visual: the investment buffet. Think of your investment options like a buffet. Stocks, spicy dishes. High reward, high risk. Index funds / ETFs, healthy staples, steady, balanced. Bonds, REITs, side dishes, add stability and income. Action step for Part 7. Take time to research each type. Ask yourself, how much risk am I comfortable with? How much time do I have? For most beginners, starting with a low-cost index fund or ETF is a smart move. Closing for Part 7. You don't need to be an expert in every type of investment. You just need to understand the basics so you can build a strong, diversified portfolio. In the next part, I'll show you how to actually open an investment account and buy your first stock or fund step by step. End line for Part 7. Stay with me, the best part is coming up next. Taking real action. Part 8. How to open your first investment account. Step by step. Now that you know what to invest in, it's time to actually get started, no more theory. In this part, I'll walk you step by step through how to open your first brokerage account, what documents you need, and what mistakes to avoid so you don't get stuck. What is a brokerage account? A brokerage account is like your bank account, but for investing. It's the middleman that lets you buy and sell stocks, ETFs, and other investments. Think of it like your gateway to the stock market. Step 1. Choose a reputable broker. First, pick a broker that fits you. If you want easy-to-use apps with no commissions, look at brokers like Robinhood, Webull, or eToro. If you want full-service, research tools, and retirement accounts, consider Fidelity, Charles Schwab, or Vanguard. Make sure your broker is reputable, regulated, and has good customer support. Step 2. Gather your documents. Before you sign up, have these ready. Government-issued ID, like passport or driver's license. Your social security number or tax ID for tax reporting. Bank account info to fund your account. Proof of address if needed. Step 3. Fill out the application. Don't get scared, it's mostly basic information. Personal info: name, address, date of birth. Financial info: income, net worth, employment, investment experience. They ask this for compliance, but it doesn't block you if you're a beginner. Step 4. Link your bank account. Next, you connect your bank account to your brokerage account. This is how you transfer money in and out. Double-check your bank details to avoid delays. Step 5. Fund your account. Deposit the amount you're comfortable investing. Start small, $50, $100, $500. Whatever fits your budget. Don't invest money you need for bills or emergencies. Safety tip: protect your account. Set up strong passwords and enable two-factor authentication, 2FA. This keeps your money safe from hackers. Step 6. Understand the dashboard. Once approved, you'll see your dashboard. This is where you check your balance, research stocks, place orders, and track your portfolio. Take your time, explore, and learn. Common mistakes to avoid. Don't open multiple accounts with money you can't afford to lose. Don't give up personal info on random apps, only use trusted brokers. Don't panic if your account takes a few days to get verified, it's normal. Action step for Part 8. If you haven't opened an account yet, pick a broker today, sign up, and get verified. This step is the real beginning of your investing journey. It'll feel real now. Closing for Part 8. Next, we'll cover what to do inside your account, how to research your first investment and buy your first stock or ETF step by step. End line for Part 8. Congrats, you're closer than ever to investing for real. Let's keep the momentum going. Part 9. How to research your first stock or ETF. Open hook. Now you have your account set up, so what should you actually buy? If you pick blindly, you're gambling, but if you learn how to research, you're investing smart. In this part, I'll show you exactly how to research a stock or an ETF step by step, even if you're starting from zero. Why research matters? Good research helps you avoid hype traps. Don't just buy because a friend or influencer said so. Learn to look at real facts and make your own decision. Basic steps to research a stock. Step 1. Understand the business. Ask, what does this company do? How does it make money? Example, Apple sells phones, laptops, and services. Simple. Step 2. Check the company's financial health. Look at revenue, is it growing year after year? Profit, are they actually making money or just surviving? Debt, too much debt can be risky. Where to find this? Use sites like Yahoo Finance, Google Finance, or your broker's app. Search the stock ticker like AAPL for Apple. You'll see financial statements, charts, and earnings. Step 3. Read recent news. What's happening? Trustworthy? Example, if a company launches a new product that people love, its sales might grow. Step 4. Compare with competitors. Don't just look at one stock in isolation. Example, if you like Tesla, compare it with Ford, GM, or other EV companies. See which one has stronger growth or a better balance sheet. Step 5. Check valuation. Is it overpriced? Look at P/E ratio, price to earnings, tells you how much you're paying for each dollar of profit. P/B ratio, price to book, for asset-heavy businesses. Compare these ratios to industry averages. Step 6. Look at historical performance. Check the stock chart for the last 5-10 years. Do you see steady growth or wild ups and downs with no reason? What about ETFs? Researching ETFs is easier. Check. What index or sector does the ETF track? What companies are inside it? The expense ratio lower is better. Past performance. Remember, past performance doesn't guarantee future returns, but trends matter. Example, for S&P 500 ETFs, compare SPY, VU, or IVV, all track the same index but have different fees. Visual, the detective analogy. Think of it like being a detective. Gather clues, cross-check facts, ignore rumors. Action tip for beginners. Don't overthink, you don't need to analyze 100 stocks. Start by researching strong, well-known companies or broad index ETFs. Make a shortlist, follow the news, and get familiar with reading simple financials. Warning: no one can predict the market perfectly. But the more you research, the better your decisions will be, and you'll invest with confidence, not fear. Action step for Part 9. Pick one stock or ETF you're interested in. Spend 20-30 minutes researching it today. Write down what you find: the business, the numbers, the news. This is how you train your investor mindset. Closing for Part 9. Next, we'll take the final leap. I'll show you how to actually buy your first investment inside your brokerage account. End line for Part 9. Keep going, you're almost ready to become a real investor with real money in the market. Part 10. How to buy, sell your first stock or ETF. Step by step. Opening hook. You. All right, you've researched your first stock or ETF. Your account is ready and you're excited. But how do you actually place your first trade without messing up? In this part, I'll show you exactly how to buy and sell step by step so you don't panic-click your way into losses. Before you click buy. Quick rule: never invest money you need for rent, food, or emergencies. Only use money you're willing to keep invested for a while, at least 3 years. Step 1. Log in and search the ticker. Log in to your brokerage account. Use the search bar to find your stock or ETF. Example: Tesla TSLA, Apple AAPL, S&P 500 ETF SPY. Step 2. Review the info. Double-check the company name, the current price, the market status, open or closed. Step 3. Understand order types. Market order: buys or sells immediately at the current price, simple for beginners. Use when you're okay with slight price changes. Limit order: you choose the price you're willing to pay. Example: if a stock is $102, you set a limit at $100. Your order only goes through if the price drops to $100 or below. Stop order: for advanced users, automatically sells if the price drops to a certain point to limit losses. Step 4. Enter the quantity. Decide how many shares you want to buy. Some brokers let you buy fractional shares, so you can buy $50 of Amazon instead of a full share. Step 5. Place the order. Double-check everything: ticker, order type, quantity. Click Buy Done. Your broker will confirm when it's filled. Mizan 6. Monitor your investment. Check your portfolio regularly, but don't obsess every 5 minutes. Long-term investing means you're not trying to time every little price move. How to sell. Selling is just as easy. Search the stock in your portfolio. Click Sell. Choose your order type and quantity. Confirm and you're out. Pro tips for beginners. Always use limit orders if you want more control over the price. Don't panic sell during normal market ups and downs. Stay focused on your goals, why you bought it in the first place. Visual example. Imagine this. You decide to buy 2 shares of Apple at $180 each. You place a limit order at $180. If the price hits $180 or lower, your order fills automatically, no stress. Safety reminder: never trade on impulse. Research, decide, place your order, that's it. Keep emotions out of your trades. Action step for Part 10. Practice: go into your account and do a paper trade. If your broker has one, it's a demo trade with fake money. Or invest a small amount, $10, $50, just to see how it works. Closing for Part 10. Congrats, you now know how to place your first real buy or sell order like a real investor. Next up, we'll tackle how to build a beginner-friendly portfolio, what to hold, how much, and how to keep it balanced. You're no longer just watching videos, you're becoming an investor. Let's build your portfolio next. Part 11. How to build a strong beginner portfolio. Buying your first stock is exciting, but one stock isn't a plan. If you want to grow wealth steadily, you need a simple but strong portfolio. In this part, I'll show you how to build a beginner-friendly portfolio that balances risk and growth step by step. What is a portfolio? Your portfolio is your collection of investments. Think of it like a basket, holding all your stocks, ETFs, or other assets. Diversification means your basket doesn't break if one egg cracks. Why diversification is important. Imagine you put all your money in one stock and that company crashes. You lose big. But if you have 5-10 investments in different industries, one flop won't ruin you. Step 1. Decide your allocation. Allocation means how you divide your money between different investments. A basic rule for beginners. 70-80% in stable, broad ETFs, like S&P 500 total stock market. 20-30% in individual stocks you believe in. Example for beginners. Let's say you have $1,000 to invest. $700. $800 in an index ETF like VOO or SPY. $200. $300 split across 2-3 strong individual stocks. Step 2. Mix by industry. Diversify across sectors, don't buy all tech stocks. For example, tech, Apple, Microsoft. Consumer goods, Coca-Cola, P&G. Healthcare, Pfizer, Johnson & Johnson. Energy, Exxon, Chevron. Step 3. Keep it simple. You don't need 50 stocks. Start with 5-10 solid holdings, easy to manage, easy to track. Step 4. Consider risk tolerance. Younger investors can take more risk, more stocks, less cash. If you're closer to retirement, add more bonds or stable dividend ETFs. This is called asset allocation. Step 5. Rebalance regularly. Rebalancing means checking your portfolio every 6-12 months. If one stock grows huge and becomes 50% of your portfolio, sell a little and spread it back out. Practical example. Example beginner portfolio, $1,000. $500 in S&P 500 ETF VEU. $200 in dividend ETF SEHD. $100 in Apple AAPL. $100 in Tesla TSLA. $100 in Microsoft MSFT. This mix is simple, diversified, and easy to understand. A common portfolio mistakes. Chasing hype stocks you don't understand. Putting all your money in crypto or penny stocks. No cash reserve, so you're forced to sell at a loss if you need money fast. The golden rule for beginners. Start simple, grow over time. Add new investments only when you fully understand them. Action step for Part 11. Write down your target allocation today. Which ETFs? Which stocks? Plan your first portfolio on paper so you don't panic buy random things. Closing for Part 11. In the next part, we'll talk about how to stay consistent and how to keep adding to your portfolio every month without overthinking. End line for Part 11. You're building your financial future one piece at a time. Keep stacking those bricks. Part 12. How to keep investing consistently, dollar cost averaging. So you've built your first portfolio, but here's a secret. Investing once will make you wealthy. Consistency is where the real magic happens, and that's where dollar cost averaging comes in. In this part, I'll show you how to grow your wealth month after month, no matter what the market is doing. What is dollar cost averaging, DCA? DCA means you invest a fixed amount on a regular schedule every week or month instead of trying to time the market. Example, you invest $100 every month in an ETF no matter if the market is up or down. Why does it work? Trying to predict the perfect time to buy is almost impossible. Even pros get it wrong. With DCA, sometimes you'll buy when prices are high, sometimes low, but over time, it evens out. This helps you buy more shares when prices drop and smooths out your cost. Simple example. Let's say you invest $100 each month in an ETF. Month 1, price $50. You buy 2 shares. Month 2, price $25. You buy 4 shares. Month 3, price $33. You buy approximately 3 shares. Over time, you average out the ups and downs. Benefits of dollar cost averaging. No guesswork. You don't stress about when to buy. Builds discipline. Turns investing into a habit like paying a bill. Reduces fear. Market dips feel like a discount, not a disaster. Long-term mindset. Keeps you focused on growing wealth, not daily price swings. How to automate it. Most brokers let you set up automatic investments, so your money goes straight from your bank to your ETF or stock every month. Set it once, check it once a month, that's it. DCA works best when you're investing in broad, diversified assets like index ETFs. You have a long-term goal, 5, 10, 20 years. You don't need that money soon. Common mistakes to avoid. Skipping months because you think the mark is too high. Pausing when you see scary news. Remember, big investors love when beginners panic. Stick to the plan. How much should you invest monthly? Only you know your budget, but aim for at least 10–20% of your monthly income if you can. Even $20. $50 a month is better than nothing. The habit is more important than the amount at first. Action step for Part 12. Open your brokerage app, set up an automatic deposit and pick a day each month. Example, first of every month $100 into your S&P 500 ETF. Make investing boring, that's how wealth builds up. Closing for Part 12. Consistent investing is what separates winners from quitters. The longer you stay in the game, the more your money grows. End line for Part 12. Up next, how do you know when to sell and when to just hold tight? Let's break that down next. Part 13. When should you sell? The right/wrong reasons. Buying is easy, but knowing when to sell, that's where most beginners mess up. In this part, I'll show you the smart reasons to sell an investment and the mistakes that cost people thousands. Why selling matters. Investing is not just buying and holding forever. Sometimes you need to rebalance, take profit, or cut losses, but you need a plan. Good reasons to sell. 1. Your reason for investing changed. If you bought a stock for long-term growth, but the company's fundamentals are declining, you may want to exit. 2. Better opportunity. You find an investment with a strong outlook and your old investment isn't performing. Example, you're heavy in one stock that's not growing. You shift some money to a diversified ETF. It is a TT 3. Company red flags. Sell if you see poor earnings for multiple quarters, leadership scandal or fraud, huge debt with no plan to fix it. 4. Rebalancing. If one stock grows too big in your portfolio, you might sell part of it to rebalance and reduce risk. 5. You need the money with a plan. If you're selling to pay for an emergency or big life goal, that's fine. But don't sell out of fear. Wrong reasons to sell. 1. Panic during normal volatility. Markets dip 10–20%, often it's normal. Selling in fear locks in your loss instead of giving your investment time to recover. 2. Following the herd. Don't sell just because everyone online is screaming about a crash. Follow your research, not the hype. 3. Short-term headlines. News headlines cause emotional decisions. If the company's fundamentals are strong, ignore the noise. Example, smart selling versus panic selling. Let's say you bought a stock at $50. It drops to $40, you panic and sell. But if you'd held, it might have rebounded to $60 in a year. Always ask, has the reason I bought this changed? How to sell smart. Set a target price before you buy so you know when to take profit. Use stop-loss orders if you want to limit big losses automatically. Rebalance once or twice a year, not every week. Taxes matter. In some countries, if you hold a stock for over a year, you pay lower taxes on gains, long-term capital gains. Selling too quickly can cost you more in taxes. Pro tip, don't fall in love. Investments are not family. Be ready to cut a loser if it no longer makes sense. Action step for part 13. Look at each investment. Is it still strong? Would you buy it again today? If not, plan your exit step by step. Closing for part 13. Selling is part of the game. The goal is to make rational moves, not emotional ones. End line for part 13. Up next, how do you handle losing money, and how do the pros stay calm when things go wrong? Let's tackle that next. Part 14. How to handle losses without quitting. Here's the truth nobody tells you. Every investor loses money sometimes. Even Warren Buffett has losing stocks. The difference is the smart ones don't panic and quit. In this part, I'll show you how to handle losses without giving up on your investing journey. Losses are normal. No one has a 100% win rate. The stock market moves in cycles. Sometimes you're up, sometimes you're down, but historically it always recovers. Example. How the market recovers. Example, the S&P 500 has had dozens of crashes, wars, recessions, pandemics, but it always bounces back stronger over time. $1,000 invested 30 years ago would be worth over $10, 000 plus today, even with market drops. Why do people panic? They invest money they can't afford to lose. They have no plan, so fear takes over. They check prices every hour. The more you watch, the scarier it feels. How the pros handle losses. 1. They zoom out. Pros don't stress about daily moves. They look at 5, 10, 20-year charts, the long-term trend. 2. They stick to a strategy. They have rules: when to buy, when to hold, when to sell. This keeps emotions out. 3. They use stop losses wisely. For high-risk trades, pros use stop-loss orders to automatically limit losses. 4. They learn, not blame. Smart investors review losing trades. What went wrong? Bad research, bad timing. They fix mistakes, not repeat them. Mindset shift. From losing to learning. Every loss is a lesson. If you learn, you're still winning long-term. But if you quit, you lock in failure. How to reduce emotional pain. Invest small. Never put in more than you can afford to leave for years. Diversify. One bad stock won't destroy your entire portfolio. Have an emergency fund. Never invest your rent or grocery money. Example, bounce back story. If you'd invested in the market right before the 2008 crash, the worst in decades, and held for 10 years, you'd have doubled your money. Time in the market beats timing the market. What not to do when you're down. Don't check prices every hour. Don't throw good money at bad if the company is broken. Don't vent trade acting out of anger, always backfires. Action step for part 14. Write down your biggest fear about losing money. Now write, how will I handle this if it happens? Having a plan takes away fear. Closing for part 14. Losses are tuition for learning how to invest. Everyone pays it, the winners just stick around long enough to profit from what they've learned. End line for part 14. In the next part, I'll show you how to track your investments the smart way without getting overwhelmed. Part 15. How to track your investments like a pro. Most beginners either obsessively check prices every hour or completely forget what they bought. Both are bad for your money. In this part, I'll show you how to track your investments the smart way, so you stay informed, calm, and in control. Why tracking matters. Investing is not buy and forget forever. You don't need to stare at your portfolio daily, but you should know what's happening with your money. What should you track? 1. Portfolio value. This shows your total gains or losses over time. 2. Allocation. Is one stock or sector getting too big? Maybe time to rebalance. 3. Company updates. Keep up with major earnings reports, big news, or leadership changes for each company you own. 4. Dividends. If you own dividend stocks or ETFs, track when you get paid and reinvest those payouts. How often should you check? Most pros check their portfolio. Once a week, quick glance for big changes. Once a month, deeper look to rebalance or adjust. Once or twice a year, detailed review of your strategy. Tools for easy tracking. Brokerage app. Most broker apps show real-time prices, charts and gains, losses. Spreadsheets. Old school but powerful, you can track. Buy price, current price, dividends, notes for why you bought it. Portfolio trackers. Apps like Yahoo Finance, Simply Wall Street, or Personal Capital make it easy to see all your investments in one place. What to watch for. When tracking, ask yourself, is my portfolio still balanced? Are any investments underperforming for a real reason? Do I need to add more to strong positions? Do I need to sell anything with red flags? Don't obsess. Checking 10 times a day makes you emotional. Big drops look scarier short-term than they really are. Use your tracking time to learn, not panic. Sample simple tracker. Stock ETF, buy price. Current price gain, loss notes, VU $350, $400, plus 14%. Hold long term. AAPL, $120. $180, plus 50%. Add-on dips. TSLA, $250. $210, minus 16%. Watch quarterly. Pro tip, keep a journal. Write down why you bought each stock. When prices swing, revisit your notes. This stops emotional decisions. Action step for part 15. Set a calendar reminder. 1 day a week, quick check. 1 day a month. Rebalance if needed. 1-2 days a year. Review your overall strategy. Closing for part 15. Good tracking keeps you focused and calm, so you stay invested for the long haul. End line for part 15. Up next. How do you protect your investments from scams, hacks, and fraud? Let's talk about staying safe. Part 16. How to keep your investments safe. Scams, security tips. Opening hook. You've worked hard for your money. Don't let scammers and hackers steal it in seconds. In this part, I'll show you how to protect your investments, avoid common scams, and make your accounts bulletproof. Why security matters. Stock market investing happens online, and that means your money is exposed to fraudsters pretending to be financial advisors, fake stock tips and pump and dump schemes, hackers trying to break into your accounts. Top ways investors get scammed. 1. Pump and dump schemes. You see hot stock tips on social media. A group hypes up a penny stock. Everyone buys price jumps, scammers sell price crashes. You lose, they win. 2. Fake brokers or apps. Scammers create fake trading apps or clone real websites. You deposit money, but you can't withdraw. 3. Phishing emails calls. Hackers pretend to be your broker or bank, asking for your password or PIN. How to protect yourself. Smart steps. 1. Use reputable brokers only. Stick with well-known regulated brokers. Check reviews and see if they're registered with your country's financial authority. 2. Two-factor authentication, 2FA. Always enable 2FA on your brokerage account. Even if hackers get your password, they can't get in without your code. 3. Strong, unique passwords. Don't use the same password for your broker and social media. Use a password manager if you have to. 4. Beware of too good to be true. If some real investing always has risks. 5. Watch out for unsolicited advice. Nobody legit will DM you asking for money to invest for you. Block and report them. 6. Keep software updated. Update your phone, apps, and computer. Most hacks succeed because people ignore software updates. 7. Use secure Wi-Fi. Never log in to your broker account on public Wi-Fi. If you must, use a trusted VPN. Signs you're being scammed. They pressure you to invest immediately. They ask you to send crypto or gift cards. They promise huge profits with zero risk. They won't let you withdraw your money. Bonus: protecting your records. Keep copies of your trades, statements, and account info in a safe place. Don't share screenshots with sensitive details online. Check your account activity regularly. Look for any suspicious logins or transactions. Action step for Part 16. Right now, enable 2FA on your broker app. Change your password if you've been using the same one for years. And always double-check URLs. Never click shady links. Closing for Part 16. Building wealth takes years. Losing it to a scam can take seconds. Stay smart, stay secure, and you'll protect your future. End line for Part 16. Up next, should you invest alone or find a community? Let's talk about where to learn, who to trust, and how to keep growing. Part 17. Should you invest alone or join a community? Investing can feel lonely, and that's why many people join groups, clubs, or online communities. But here's the catch. The right community can help you grow, and the wrong one can drain your money and your confidence. In this part, I'll show you the pros and cons and how to find people who actually make you better at investing. Why people join investing communities. Nobody wants to feel like they're guessing alone. Communities give you access to new ideas, a place to ask questions, motivation to stay consistent. Types of investing communities. 1. Local investment clubs. Small groups meet monthly. They pool money, share research, and invest together. 2. Online forums. Social media. Places like Reddit, r/stocks, X, Twitter, Facebook groups. Lots of opinions, some good, some terrible. 3. Paid courses, mentorships. You pay for a structured program, webinars, or access to an expert. Pros of joining a community. Accountability. You're more likely to keep learning and stay invested. Learn faster. You hear different views, get feedback, and avoid mistakes others already made. Emotional support. When markets crash, it helps to see you're not alone, others are holding too. Cons of the wrong community. Herd mentality. People hype up bad stocks. You feel pressured to follow the crowd. Misinformation. Anyone can post advice, but not everyone has real experience. Scams, paid pumpers. Some groups secretly push certain stocks for profit. How to find a good community. 1. Look for evidence-based discussions. Real investors share data, charts, and research, not just hype. 2. Small, moderated groups are better. Too many voices chaos. A tight group with clear rules is safer. 3. Never share sensitive info. Don't reveal your brokerage logins, big portfolio screenshots, or bank details. 4. Don't take every tip blindly. Use ideas as inspiration, but do your own homework. What if you want to invest alone? That's fine too. Many pros trade solo. If you're disciplined and keep learning, you don't need a community, but having one can help when you feel stuck. Pro tip: keep a personal circle. Even if you're not in a big group, find 1-2 trusted people, friends, mentors who are serious about investing. Bounce ideas off each other. Action step for Part 17. If you want to join a community, pick 1 or 2 that fit your style. Lurk first, watch how they share info. Add value too, share what you learn. Closing for Part 17. A strong community can inspire you to stay the course. Just remember, your money, your responsibility. End line for Part 17. In the next part, we'll cover a hidden skill. How do you keep learning and improving as an investor for life? Let's talk about it. Part 18. How to keep learning, improving as an investor. Markets change, new companies rise, and old ones fall. The one thing that keeps you ahead is learning. In this part, I'll show you exactly how to keep growing as an investor so you don't get stuck or left behind. Why lifelong learning matters. Investing is not a set-it-and-forget-it forever game. Yes, you don't have to watch the market every hour, but you do need to level up your knowledge every year. What to learn and why. 1. Business economic trends. Learn how different sectors move. Example: how does AI affect tech stocks? How do interest rates affect real estate and banks? 2. New tools platforms. New investing tools come up all the time: robo-advisors, portfolio trackers, tax optimization apps. Using better tools gives you an edge. 3. Tax legal changes. Governments change tax rules. Knowing how to legally reduce taxes on capital gains or dividends keeps more money in your pocket. 4. Your own psychology. Most people lose money because of panic and greed. Learning how your mind works under stress is the biggest edge. Where to keep learning. Books, audiobooks. Investing classics: The Intelligent Investor, Common Stocks and Uncommon Profits, or One Up on Wall Street. Podcasts, YouTube channels. Great for staying up to date on trends and news. Courses, workshops. Some investors take advanced courses on valuation, technical analysis, or options. Annual reports, earnings calls. Reading company reports teaches you how real businesses perform, not just stock prices. How the pros do it. Warren Buffett reads 500 pages a day. He doesn't just watch price charts, he understands the business behind the stock. Ray Dalio journals his trades. Pros keep notes. Why did I buy? Did it work? What will I do differently next time? How to build a learning habit. 1. Schedule learning time. Even 30 minutes a week adds up fast. 2. Keep a notebook or journal. Write down lessons from wins and losses. 3. Join webinars or investor meetups. Connect with people who know more than you. Warning: don't get overloaded. More information isn't always better. Pick trusted sources, filter out hype. Action step for Part 18. Pick 1 investing book, 1 podcast, or 1 course you'll commit to this month. Write down 3 things you learn and test them out. Closing for Part 18. The market keeps changing. The best investors keep adapting. If you keep learning, your money will keep growing. End line for Part 18. Next, let's talk about when and how to take profits. How do you know when it's time to sell? Part 19. When should you take profits? Knowing when to sell. Buying is easy, but selling, that's where most investors mess up. Sell too early, you miss out on bigger gains. Hold too long, you watch your profits disappear. In this part, I'll show you how smart investors decide when to cash out. Why knowing when to sell matters. Selling is one of the hardest parts of investing. You can't time it perfectly every time, but you can follow principles that protect your profits and your mindset. 3 common times to sell. 1. When your investment goal is hit. Example, you plan to make 40% on a stock, it hits 40%. Take your profit. 2. When the fundamentals change. If a company's business weakens, bad earnings, lost major clients, or bad leadership, it may be time to get out. 3. When you need to rebalance. If one stock or sector gets too big, you may sell some and spread it out to keep your portfolio balanced. How the pros manage profits. They use trailing stop losses. Set a stop loss order to sell if a stock drops a certain percentage below its highest price. Example, stock goes from $100 to $150, you set a trailing stop loss at 10%. If it falls to $135, you lock in profits. They trim gradually. Pros often sell a position in parts. Sell 25% when you're happy, let the rest ride. They don't get greedy. Greed makes you hold forever. Have a plan, follow your exit strategy. When not to sell. 1. Because of panic headlines. Markets dip all the time, corrections are normal. 2. Because you're bored. Holding good companies long-term is boring, but it works. 3. Because everyone else is selling. Herd mentality ruins portfolios. Questions to ask before selling. Is my reason for buying still valid? Is the company still strong? Am I reacting emotionally? Do I have a better place to put this money? Taxes matter too. In some countries, if you hold investments for more than a year, you pay less tax on profits. Short-term trading can cost more in taxes. Always check how selling affects your tax bill. Pro tip: reinvest wisely. Taking profits is only half the game, the other half is putting that money back to work. Keep your cash moving. Action step for Part 19. Look at your portfolio. Identify any positions that hit your target or no longer fit your plan. Decide sell all, sell some, or hold. Closing for Part 19. Remember, it's better to take a good profit than to dream about a perfect one. Discipline beats greed every time. End line for Part 19. Next, the big finale. How do you stay consistent and keep growing your portfolio year after year? Let's wrap this up with a powerful plan. Fantastic! Let's keep your masterclass rolling. Here's a practical, detailed Part 19 for how to start investing in the stock market. 3 common times to sell. 1. When your investment goal is hit. Example, you plan to make 40% on a stock, it hits 40%. Take your profit. 2. When the fundamentals change. If a company's business weakens, bad earnings, lost major clients, or bad leadership, it may be time to get out. 3. When you need to rebalance. If one stock or sector gets too big, you may sell some and spread it out to keep your portfolio balanced. How the pros manage profits. They use trailing stop losses. Set a stop loss order to sell if a stock drops a certain percentage below its highest price. Example, stock goes from $100 to $150, you set a trailing stop loss at 10%. If it falls to $135, you lock in profits. They trim gradually. Pros often sell a position in parts. Sell 25% when you're happy, let the rest ride. They don't get greedy. Greed makes you hold forever. Have a plan, follow your exit strategy. Part 20. How to stay consistent, grow your portfolio. Long term. You've learned how to pick stocks, manage risks, and protect your money. Now comes the most important part, staying consistent for years. In this final part, I'll share how the best investors build wealth step by step without burning out or giving up. Why consistency wins. Every time. Anyone can make a lucky trade, but real wealth comes from good habits repeated for decades. Warren Buffett made over 90% of his wealth after age 50. Why? He stayed in the game. The core rules for long-term success. 1. Keep investing regularly. Set up automatic contributions every month or quarter. This is called dollar cost averaging. You buy at highs and lows, it balances out. 2. Reinvest your dividends. If you own dividend-paying stocks, don't spend that money, reinvest it. Compounding is your best friend. 3. Review and rebalance yearly. Once or twice a year, check your portfolio. Are you too heavy in one stock or sector? Rebalance. 4. Keep learning. Stay curious. Read books, watch interviews, follow market trends. The economy changes, your knowledge should too. The power of patience. Markets will crash, they always do. But over time they recover and grow. Panicking during a downturn is how most people lose. Example. If you'd invested $10,000 in the S&P 500 in 1980 and just left it alone, you'd have over $1 million today. Avoid these long-term mistakes. Trying to time the market. Even pros can't do it consistently. Following FOMO or hype. Stick to your plan, not trends. Quitting too early. Consistency talent, the best investors stay in the game when others panic. And your final action plan. Step 1. Automate your investing. Treat it like a bill you pay yourself. Step 2. Keep an investing journal. Record what works and what doesn't. Step 3. Surround yourself with people who inspire you to keep learning. Your wealth-building mindset. Your portfolio is like a tree. Plant it, water it, protect it, and it will grow. Don't keep digging it up to see if it's growing. Closing for Part 20. You've just completed a full blueprint for starting in the stock market, from the basics to advanced tips. The rest is up to you. Take action, stay patient, and trust the process. End line for Part 20. Remember, money grows when you do. Keep learning, stay disciplined, and one day you'll look back amazed at how far you've come. Thanks for watching. I'll see you at the top.